In this part, I'm introducing some special valuation cases. The first one is valuation using relative sales value. And this method is we use price to determine the cost. The idea is because cost and price in most cases are matched. Single lump sum purchase. In this case, is a purchase of a land. The price of a land is $1 million. And the land can be subdivided into 400 lots. And the lots, depends on its condition, can be sorted into 3 different groups, A, B, C. And A, B, C will have different values. Even in the same community, some location may be better, so the value of the land are different. So, how to calculate the cost of lots to be sold and the gross profit? Because this is a lump sum purchase, the 400 lots totally worth $1 million for each lot. How we determine the cost of a lot? Because only when we know the cost of a lot, we can determine the profit margin when the firm sells them. If a lot's market price is higher, its cost should be higher. So there are total 400 lots, 3 groups, A, B, C. A 100, B 100, C 200. And we know the price of each group. The highest A is 10,000, B 6, C is 4,500. So that's the sales price or market value of each group. Next is to determine the cost. We know the total cost is $1 million. We first multiply the cost per lot with the number of lots. We can get the total market price of the land. For grade A is 1 million, grade B 600, grade C is 900,000. So the total market price of this land or these 400 lots is $2,500,000. $2,500,000 is the total revenue of the 400 lots. How we get the relative sales price? So for this one is the sales price per lot multiply number of lots divided by 2,500,000. So it is 100 over 250. The next one, 6,000 multiply 100 divided by 2,500,000. Last one is 4,500 multiply 200 lots divided by 2,500,000. So it's 90 over 250. Actually, you add all of 3 together equals 1. Next, we use the relative price multiply the total cost. We can get the cost per each group. And each group, the total cost divided by number of lots. We can get the cost each lot. Yeah. So first one is divided by 100. This is divided by 100. This is divided by 200. So when we have the cost per lot information, if there's any lots sold, we can determine the cost for the lots sold and also the sales revenue. Because we have the sales price per lot, number of lots sold, we can determine the gross profit margin. The idea of this case is we use the price to determine the costs. It makes sense because usually if the price is higher, it's reasonable to assume the cost is also higher. The next one is purchase commitment. It is a commitment. It is not a real purchase. So the seller still retain the title or ownership of the merchandise. The buyer does not recognize any asset or liabilities. But as long as the contract is ineffective, if there is a difference between contract price and the market price, the buyer should recognize the unrealized holding gains or losses depends on the difference between contract price and market price. So purchase commitment, just like a future, it is used by the buyer to lock the price, but the market price keep changing, sometimes lower, sometimes higher. In this example, the contract price is $10 million. By the end of the fiscal year of 2017, the market price is $7 million. So the buyer should make this journal entry, debit unrealized holding loss $3 million, and the estimated liability on purchase commitment $3 million. Even there's no transaction has been executed, the buyer has to recognize unrealized holding gains or losses and liability. And unrealized holding gains or losses will be recognized in the income statement, and estimated liability on purchase commitment will be recognized as current liability in the balance sheet. Next year, when the contract is executed, the buyer should pay the contract price $10 million, and the inventory recognized is based on the market value, and the liability will be settled. So in this transaction, the firm actually paid $10 million, just acquire $7 million inventory. The difference, $3 million, has been recognized as losses in the income statement. If it is renegotiable, for example, the seller permit the buyer to reduce its contract price by $1 million, that actually is the estimated liability will be decreased $1 million, and unrealized holding losses will be decreased by $1 million. So we credit estimated liability on purchase commitment and debit unrealized holding losses